Okay, so for my PowerPoint presentation, I chose case 23, when in doubt hedge. I chose this because it deals with exchange rates, foreign currencies, and I took FI 540 this semester, and I learned a lot about this, so it was pretty easy for me to do. Okay, so for our case summary, we have the Prefab Pipe Corporation, which specializes in the manufacture of high-grade copper piping, headquartered in Delaware, and they have 4 manufacturing facilities in Illinois, California, Ohio, and Pennsylvania. They do a lot of business in the United Kingdom. Actually, 70% of its sales were accounted for by exports to the United Kingdom, while the rest, so only 30%, came from sales to wholesalers in the United States. Over the past year, copper prices had fluctuated significantly. Unable to purchase high-grade copper at stable prices, this has led to significant erosion of corporate profits despite surging sales. The Prefab Pipe Corporation had reported a sharp drop in earnings per share despite a consistent increase in revenues. So sales are going up, but their EPS is going down. And previous CFO Mitch Graves had never hedged the company's commodity and exchange rate exposures at all. Upon Mitch's retirement, Brian Daltrey was hired as the new CFO. Brian's first move was to recruit Kirk, a derivatives expert. And these are just some terms to know before we get into this. So currency call options is a contract that grants the right to purchase a specific currency at a specific price within a specific period of time. Currency put option provides the right to sell a specific currency at a specific price within a specific period of time. This is used to hedge future receivables, so that's a big one that we use. And then transaction exposure, the sensitivity of the firm's contractual transactions in foreign currencies to exchange rate movements. A forward contract, an agreement between a multinational corporation, that's what MNC stands for, and a foreign exchange dealer that specifies the currency to be exchanged, the exchange rate, and the date when transactions will occur. And future contracts are contracts specifying a standard volume of particular currency to be exchanged on a specific settlement date. They're similar to forward contracts but differ in how they are traded. Forward contracts are more tailored, where future contracts are more standardized. Okay, so question 1. What is meant by the term transactions exposure? What kind of transactions exposure is the Prefab Pipe company faced with? Well, transactions exposure refers to the short-run financial risk faced by a firm that needs to buy or sell goods at uncertain prices or rates in the future. The Prefab Pipe Corporation has to deal with the change in copper prices as well as the exchange rate between the US dollar and the British pound. And a rise in copper prices and a strengthening dollar would result in high prices for the Prefab Corporation. How much variability has there been in the spot price of high-grade copper over the past 12 months? Is it large enough to warrant the need for hedging? Please explain. Well, for starters, over the past 12 months, the mean spot price was $267.83. And the company, they're doing a lot of business. They need about 40 million pounds worth of high-grade copper by the end of 3 months to manufacture the pipes. So just by the amount of copper they need, yes, you need to hedge. I mean, that right there warrants enough. I mean, it is large enough to warrant the need for hedging, especially since orders were booked when copper prices were at their lowest level. So when they were at their lowest level, they should have bought as much copper as they could have. How should Kirk respond if Brian argues that there is a good chance that copper prices could be coming down? Kirk should tell Brian that the company won't benefit from the cheaper price of copper if the exchange rate went up. Price fluctuations could go either way, and copper prices could be substantially higher, and the company could protect itself from higher prices by hedging. When in doubt, hedge. Why is Kirk concerned about the dollar strengthening in value against the British pound? Kirk is concerned because 70% of sales, over the majority, were accounted for by exports to the UK. If the US dollar strengthens against the British pound, the conversion of pounds into dollars would bring in less dollars. This hurts the company's return. Question 6. What hedging strategies can Kirk recommend to minimize the impact of exchange rate volatility? Kirk can recommend to buy enough futures contracts which mature at about the same time that the payment is supposed to receive. So they buy these future contracts and they wait until they're about to get the receivables or the payment, and then they sell them to hedge. Besides currency futures contracts, futures options on British pounds, currency swaps, and forward contracts can also be recommended to minimize the impact of the exchange rate volatility. And question 8. Brian questions Kirk, what about forward contracts? Why not use forward contracts instead? How should Kirk respond? Kirk should tell Brian that forward contracts are not supervised and organized like future contracts are. Forward contracts aren't guaranteed and can be defaulted on, and credit risk is a big factor. Future contracts are safer and standardized, and with this size of a deal, safety is very important. And question 10. Besides an interest rate swap, what strategies could Kirk recommend to Brian to help minimize the company's exposure to interest rate risk? Kirk could recommend interest rate options in futures to hedge interest rate risk. With options, the firm could buy puts on T-bond futures so that as rates rise and bond prices fall, the puts make money and offset the higher cost of borrowing. And that is it.